Peter Rose, Longwood Currency Trading. Another day loss, but I'm $1,000 up for the week, so not too bad on that. I just wanted to make this video because a recent one was where I had a $4,000 loss on a closed day, and that was my first losing day of the year. And so now, right after that, we're having another losing day of the year. It was about a $1,200 loss today on an 8 full lot, so not a real big, well, it was, you know, I think it's 1.6% against my risk, which isn't that bad. It was another carry trade that I was involved in. I'm still looking to pick up some of this momentum that we're seeing in the price, and so Monday, today that I'm filming this is a Friday. The Monday I made just about $900 on Monday. On Tuesday I was up about $1,200, and then now today, Friday, I take about a $1,200 hit. It washes out for the week to be pretty close to $1,000 up for the week. So I'm good for the week, but I had my second losing day for the year, and I just thought it was kind of unique that I would have last week on a Friday was a $4,000 loss. I talked about that in my last video. $2,000 of that was a carry interest loss, and the actual trading loss was $2,000. It was still a $4,000 loss, but it was 1.6% against my bank. That was on a carry trade that I was $20,000 or $30,000 behind on because I was carrying 25 full lots. I was way too heavy into it. This particular loss that I took today after carrying it over from Tuesday, it was a late Tuesday afternoon that I decided to stay with it, carried it through Wednesday and Thursday, so 2.5 day loss. And the reason I got out was because it's a Friday, and there's a lot of turmoil still going on in the markets, a lot of changes, and I just don't want to get stuck. I was looking at the trade yesterday, and it was heading back down in my direction. The trade was underwater about $5,000 or $6,000. Now, you know, my profit target on this stuff is like about 10, so I'm trying to balance what I have as a good win to loss ratio on my trades. And so I'm thinking, well, I took a big hit last week. I've done really well Monday and Tuesday. Let me try for another one. It's probably too volatile of a market to be trying to look for longer profit targets, the targets that are going to go over 8 or 10 pips, because you get this volatile spike down, and if you're staging in, you pick up all those lots, and then the thing goes back or up, whatever, in the other direction, and now you've doubled your lot size and you're underwater twice as bad. And so in looking at the trade Thursday, and knowing that a lot of times Thursday night going into Friday, you get some volatility, and I could get a spike, and I thought, you know, I'm underwater quite a bit here, but if I doubled my position by staging in as price came back, if price didn't come back, I'd still be way out of the money, and I could make a decision Friday as to whether I wanted to close out or hold that over the weekend. But if this is going to move, there are going to be a lot of people that are on the wrong side of this thing, and they're going to try to clear their positions, which will mean it will go in my direction that I need it to go in. So if I stage in a few lots and double up, I'll bring my average price closer to the current price, and then I don't have so far to go to get, instead of a long profit target, I go to a short profit target, but because I have a lot of lots, I'd still have a $5,000 or $6,000 target, even though my original target would have made that a $10,000 or $15,000 target. Let's not stretch it. So the thought was, maybe Thursday add some lots to stage in as the price came down. Well, guess what happened when I got up Friday morning today? If I would have staged those lots in, they would have all got kicked. I would have been deep into this shit, well over 10 lots, and the thing would have moved a lot of pips against me to the point where I could very well have been $12,000 or $15,000 underwater. And again, not a whole lot of pips because I would have been large lot size. So I said, well, I'm glad I didn't do that. Let's see what happens as this thing comes down, because it was still 5,000 against me. It came down. I was it was $500 against me at one point, and I'm thinking, and it was spiking. I mean, I'm looking at a 15-minute chart, and this thing had come down. I mean, it was like just a straight line over two 15-minute candles, 60 pips or something like that. Again, is this sustainable? No, it's people exactly the way I've called it. They're flushing out their positions, but the place where I have my average price is right at the bottom of this big congestion zone of buying. So I don't think this thing is going to stick. I don't think it's going to keep going. I don't think I'm going to get $15 of profit. Let's just get out while I can. And that's when the buying started. I'm short on this position, and that's where the buying started. And it went from $500 against me to $3,000 against me, back to $2,000, back to $1,800, back to $2,800, back to $1,800. I hit the button, and I get out on a final spike down about $1,200. So I think I came out really good on that, because if I would have stayed with that, I would be sitting now with still with about $4,000 profit, because all these folks that were wrong are getting out and cashing out like I did and adding to the cluster. And so prices reversed and gone back up. So I'm good with that. So you can't just, the point of the video here is that you can't just set it and forget it. If you're going to trade and you want to go off onto the long-term charts and you're not really cognizant, you're not an experienced trader, you're not aware of the economics behind the order flow that's going on in that particular price action that's happening, and you set a trade that's going to go for 3 or 4 days, and you're not really experienced, you're done. That's why I think the shorter term day trading is better. Yes, you do have to trade more, although I don't. I trade once a day, and I make, the other day, Monday, when I made the $900, I think that was done in, that was 3 positions. 2 quick losses and a big hit. Okay, it's, you know, the $1,300 that I made on Tuesday, that was the same thing. It's about 3 trades. That's fine. And so it's not like you're scalping. You don't have to scalp. I think the problem with a lot of folks that are asking for my advice and emails and stuff, and by the way, thank you for your emails. I really appreciate that. That means you're taking the conscious effort not to just barf some comment out on the thing, which I appreciate those as well, but to take some time to really want to interact with me and maybe establish a friendship and work together as fellow traders. That's great. I don't care whether you're trading 2 lots or 200 lots. Doesn't make any difference to me. You trade. But in working in a short-term environment, day trading, you can make those decisions. You're right there. You're sitting there. And I don't mean I want to sit there for all day. I mean, I sit there at my desk and I write and I do other stuff, and I have correspondence that I do, and I write, and I got other stuff that I do. So the trading platform is open, and, you know, If I happen to be in a trade or in a cluster of trades, I don't mind sitting there for a couple of 3 hours and making the trades out. But my goal is, when I sit down, I don't want to be involved in the markets for more than a couple hours. I think in a couple hours, I'm trading on a 5-minute time frame with a 5-period ATR. I've got 12 opportunities an hour to determine whether there's a trade to take, and 12 opportunities an hour to decide when to get out of that trade. So, I mean, how much more decision process do you want to make? You look at it, you determine, you do shotgun trading on a short-term time frame. You make 8 pips, you make on a full lot, you make $80. Well, what's wrong with that? If I trade a 10 lot, I'll make $800. I'm sorry, if you're trading 2 lots and you make 8 pips, you've made $16. Okay, but you can't try to make 100 pips trading your 2 minis so that you make $200. That isn't going to happen. You want to go out and trade on the daily charts? You're trading a small account because either you don't have the money or you don't have the experience to want to risk that amount of money. So if you don't have the experience, why would you go out onto longer term time frames? Because somebody tells you it's safe? With a degree in physics and 33 years of software engineering, where my job is to find the problems and solve the problems, and then in 40 years of real estate investment, total risk management, I think I know a thing or two about long-term investing versus short-term trading. And that's why I'm out of real estate. That's why I closed my real estate portfolio out a couple of years ago, because I didn't want to go through another down cycle. The cycles, I've lost $1 million twice in my life in economic collapses. And it took 10 years each time to make the $1 million back. I don't want to go through that again. I'm 73 years old. And why would I want to do that when I was young? I did it when I was young because I was a software engineer and I had a day job and I had the time to let it grow, because that's what you do with real estate. You don't trade real estate short term unless you want to flip. And I know a lot of flippers, and I talk to some, and when the economic downturns come, they're in there with their heaviest weighting, which maybe that's what you do when you're short-term trading too. But in short-term trading, you get out right away. In long-term trading, you could get out right away on a currency trade. But in real estate, you can't. You're stuck with 3 or 4 flips that are going on. You're tied up. You get tied up in the banks with financing, or you get a partner that's put up the money to do the financing, and you're doing the find and search and renovation, and then sells, and you're splitting the profits with that person. Did you want to get caught on a downturn swing in the real estate market holding 6 flips? I don't think you want to. You know, what was that show on Bravo, Flipping Out? And he was doing the flips, and he got caught and lost a lot of money. But he had made a ton of money. So he was able to pivot his business and go into renovating and remodeling other people's homes. And he did great with it, and he made a lot of money. But he wasn't doing any flipping anymore because the market had turned against him. Now, he might have been able to get out of everything okay. I don't know what his situation was. But all I'm saying is that when you're in a long-term trade, you're married to that trade. You really, really believe in it. So how much more difficult is that to get out of when it starts to go against you? When you're in a short-term trade and it starts to go, it's 3 or 4 or 5 pips against you, you're starting to go, maybe this thing isn't working out. It goes to 8 pips and you're going, man, this is definitely looking bad. You hit 10 pips, you better be out of there, because that 10 pip loss could go to 20, 50, 100. And while you're sitting there twiddling your thumbs, you could pin bar out and really get caught bad. And so by trading short, what do you care? It's 8, 10 pips. Boom, you're gone. You wait, the price comes back, you go back in. You lose 10 more pips, okay, you're out, you're done for the day. Or you wait and it comes back and you go in, you get a good win-to-loss ratio because you're able to judge your entry analysis really well, and you go back in, and it makes you maybe it makes you 10 pips, but this time instead of doing it on 2 lots, you end up with 8 lots, and you make your 8 pips with $80 $80 a pip times 8 pips. you did pretty good. And it only cost you 10 pips twice on maybe a 2-lot. Yeah, I'm just saying, if you don't understand how to work through the mathematics of risk management, you're really doing yourself a disservice by listening to these jackasses on the videos telling you how simple all this stuff is, and all you got to do is this and that and the other thing. And if you're going to long-term trade, a 50 pip loss with a 150 pip gain is a good situation to be in. That situation sucks. I'm just telling you what the math of it tells me. I believe in the math. I believe in probability analysis. And if you don't have a good win-to-loss ratio, you're kidding yourself. So the fact that I'm trying to share with you my experiences in trading and the problems that I'm having by trying to map my risk management, 40 years of real estate risk management, down into currency trading, it's been very, very difficult for me. And I've lost a lot of money because of that. And that's solely, not solely because of that, but also because I trusted all these people that are out there doing videos and all this stuff, and they really don't know how to trade. They got lucky and they made some money, and that's great. And you know, but you can't sit there with your 6-figure account and then try to tell other people how they ought to trade by taking no more than a 1% risk on your thing and talking about risk-reward ratio. You can't do that because that's not how they made their money. They either made it blindly and just doubled up 4, 5, 6 times with a 200-to-1 leverage, or whatever it is that they did, they were able to grow their way through. But now they're talking about fucking Fibonacci numbers and RSI and Bollinger Bands and all this other kind of crap because they don't really understand how they made their money. And so they say, oh, I did it because of Bollinger Bands and Fibonacci. I'll tell you what, anybody that trades based on Bollinger Bands and Fibonacci is going to lose unless you override those decisions and make the trades based on good trading. And then later, after the fact, oh, that's the 68 Fibonacci number. Well, yeah, but if you try to trade on the 68 Fibonacci number the next time, it won't work. It'll be the 38 or the 33. I don't know Fibonacci, whatever the friggin' numbers are. It's always easy to look back and say, oh, the 50% Fibonacci held, or the 34%, or the next, or this is blowing by the 50% Fibonacci. The next up is the 68. So it didn't hold. It didn't hold here. It'll hold at the 68. That's stupid. What the hell does a Fibonacci number have to do with order flow in the currency markets? Please don't contact me if you believe in that stuff, unless you want me to go through with you the reasons why you shouldn't be. But I don't have to do that. Why pay me hundreds and hundreds of dollars an hour for consulting when you just go back through my videos? All the proof of it is there. You know, and I get these, oh man, I tell you, I got this guy emailed me the other day. Thank you for your email, but you're an asshole for saying, oh, you got to provide me, you know, I listen to your videos and you're talking about how much money you make and you're doing this and you're doing that. Show me your statements. Where's your statements? I don't want to believe, you know, you got to be transparent. Fuck you. I don't have to be transparent. I'm telling you the issues that I'm going through and the transitions I'm going through, and based on my knowledge and my experience, this is the way it is. Not the way some dumbass that crawled out from under a rock and got lucky with 200-to-1 leverage and he's blowing shit in your ear that you can trade on your fucking iPhone. I'm sorry, but you know who you are because you're obviously watching my videos. And don't send me another email, okay? And just please unsubscribe to the channel because you obviously don't know what you're doing, and all you're doing is looking to poke fun at me. Don't. And don't bother leaving shitty comments either about what an asshole I am, because that's your opinion and my trading is my opinion, and if you don't believe in the results that I'm telling you about, don't watch my channel. It's as simple as that. That's the last time I'll address crap like this. Please, when you're doing your trading and you're contemplating more complex strategies, compounding, staging, and all this other stuff that I'm talking about because I'm dealing with six-figure account, you have to understand why I'm doing what I'm doing so that you understand the benefit of all in, all out for what you're doing. How do you plan that trade? How do you do your entry analysis so that you can learn good trading? Staging has nothing to do with good trading. Staging is simply reducing the amount of profit that you're going to get if you would have gone all in and all out. Staging is part of risk management. It's an advanced form of risk management that allows you to increase the amount of money dramatically when you have a runner. But it isn't, you're not supposed to be staging unless you're going to do a runner. And that's where you get into trouble. That's where I get into trouble because it's kind of counterproductive, not productive, but counter to the types of risk management that is ingrained in me that's part of my real estate background. And so don't encumber yourself. Don't listen to these guys on these videos telling you how to do all this stuff and Bollinger Bands and all the rest of it. It has nothing to do with it. Look at your chart, maybe with a moving average line so you can kind of see what the past order flow is doing and learn how to read the chart. And then that will give you some questions. Well, why did this spike up? Well, it was order flow. Well, what does that mean? Why did it spike up to where it spiked up and not to here? Or why did it go only down only this much instead of that much? And then try to find an answer for that. And then, well, price was in this great trading trend, and then all of a sudden it started to chatter along, and what's it going to do now? Do I need another kind of trading in order to do that? And I'm also losing a ton of money. Well, maybe you're been trained, or you think that this particular methodology for trading in a trending environment is going to work in a range-bound environment, and it isn't. You're going to get chopped up. Well, what do you mean by that? Look it up. Look at the chart. Look at where the crosses are and the actual price that you're going to get when it crosses, and you'll go, of course that's not going to work. Is a moving average crossover system going to work on a long-term chart that's going to run for 6 weeks? Sure it is. But eventually what's going to happen is you're not going to know when the chop is going to start. If you look back at a chart and you go, oh, look at this big range, and I would have got out up here. Well, what if you were in the thing and you had a retracement and that price began a cut down on you and chopped you out? You'd probably be too close to your entry price and you'd lose. I mean, everything is so much simpler when you can do it after the fact. And so many of these guys talk after the fact. And so many of them think that they need, the ones that are pretty good at trading seem to be compelled to have to get up and show you live how they're trading. But how they're trading is not how you're going to trade. When they say, oh, this engulfing candle means I need to go here and do this. No, it doesn't, because there were 4 engulfing patterns before that. Why didn't you take one of those? It's because of your knowledge, their knowledge of the price action for that particular currency pair that enabled them to say those engulfing patterns were not valid, but this one is. Are you going to be able to do that? No. After you have experience, maybe you will, but what are you gaining experience at? You're not going to gain any experience by taking engulfing patterns and losing and trying to figure it out because you don't have enough background to know why you lost. You just lost. And because you've got a low win to loss ratio, you're going to end up running your account to the wood. Man, it's so simple. It's so simple. It gets a little more complicated when you start trading big money, 5 full lots and up, because then you start compounding and you start averaging. I don't compound on that type of basis. I compound when I have more money in my bank. So if I'm trading 5 full lots, I'm not compounding to 5.3 lots or 5.6 lots or whatever. When I get another $10,000, I'll add that to the account, and instead of trading 5 lots, I'll trade 6. That's just the way I do it. That's one of my risk management principles. And so, are you going to be able to duplicate that? No, just by listening to it. No, you'd have to interact with the person who's doing the trading to see whether you're able to duplicate that, or whether you're even ready to do that, whether you've done your fundamentals or not. Most of these folks out there that'll do consulting or teach you courses or whatever, they're either going to teach you baby shit that you can learn for free, or they're going to try to teach you how to compound and do all this exotic stuff because, oh, isn't that worth the money? It's not worth the money because you're going to lose all your money in the end. And nobody wants to take my courses or consult from me, because if you do that, you start with $1,000 and you start learning how to trade. Most people don't want to learn how to trade. They want to learn what the magic secret sauce is so they can run their stupid friggin' 5 mini lot account to $30,000. It's really sad that 90% of the people think that way, but those are the 90% that are going to lose their money anyway, regardless of what happens, because they're not going to want to listen to reasonable activity. So although I had another day of loss, my second daily loss this year, there will be more, and that's okay, because on a daily basis, my per transaction win to loss ratio is really good. So on the whole, on a trading basis, I should be able to come out ahead, even though on a day that I lose, that daily loss will probably be a big one, simply because I've been in there chattering around, and then I've made the wrong decision during that period, and it'll take that profit out, and it'll take the next, probably double that. That's just the way it is. But that's okay, because I'm trading with an account that's large enough that if I take a $1,200 hit, or I take a $4,000 hit, or a $10,000 hit, it's going to hurt, but I can make that back. The $4,000 loss that I had on last Friday, Monday I made $900 of that back. Tuesday I'd made $1,200 more of that back. Okay, so I'm almost $2,200 back. I've almost, in 2 days of trading, I've made I've made half of that back. And then I end up in a carry trade, and I swing for the fence, and I made the wrong decision, so I take a $1,200 hit, but I'm still up $1,000 for the week. So I've still made $1,000 of that $4,000 back. It's all about the numbers and how you view your ultimate perception of a reasonable gain on a per trade basis or on a daily basis or whatever it is. And then you have to go through and have to work out the mathematics of what that represents in pips, and then trade by the pips, not by the dollars, because if you trade by the dollars, you'll get distracted. And you need to learn not to do that, because when you get up into the higher bank sizes, where you have to start staging and you're compounding and you're doing all that stuff, you don't want to have to be, and then you have to trade by dollars, because that's what all the theory is based on, is trading by dollars, not by pips. You can't trade by pips when you start staging. You don't trade by pips. You have to trade by dollars, because it's your dollar risk per staged environment that creates an average position value in relationship to where current price is, that determines whether your staging is going to be successful or not. And so you have to be really, really, really careful of that. But if you don't understand basic trading to start with, you won't be able to do that when you get a big account. So even when you grow yourself to that big account and you start trading and you're trying to do all this fancy stuff, it ain't going to work for you, because you don't understand the real fundamentals. Please take the time to learn the fundamentals. And if you're in that 21 to 34-year-old age group watching this, you've got 20 years to learn how to do this, but learn how to do it the right way, so you don't end up doing it like I did, and listen to all these guys when they're doing their trading and setting up these stupid freaking trading plans that have absolutely no basis in reality, trying to use indicators and all this other shit and lose $40,000. I came out of simulated accounts over a 4-year period of time where I was making 15% a month on the money. I thought, well, even if I'm half wrong, I'm doing really great in a live account. Lost $40,000. Boom, just like shit through a goose. I'll leave you with that. Happy thought. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.